We are going to be chatting about how much money you actually need to purchase a home. And that all factors into home prices as well, because home prices are increasing more and more and more. And it's not going backwards. It's going to continue to increase as time goes on. I actually have a chart that I'm going to show a little bit later, which is actually going to show that increase that we've been having in the housing market over the last 60 plus years. But getting into the topic for this episode, we've got six-figure incomes, which was in an article. We hinted at it last week, but talking about it more in depth this week, that people who live in Atlanta need to have in order to be able to purchase a home. So it used to be that Atlanta was one of the more affordable places for you to live in terms of major cities. I mean, obviously, if you went to New York City, it's expensive. LA is expensive. Dallas, Texas is expensive. Boston, you want to go down to Miami, expensive major cities. Atlanta was known as a more affordable major city for you to live. You could, and being an ATLian, you could go to Atlanta and get a house for $200,000. You can get a house for under $200,000 at one point. A 3-bedroom, 2-bath for well under $200,000. Be doing well, and that was literally just like 2 decades ago. Not that long ago, even. And now we're at the point where housing prices are, up over the 400,000 mark for a lot of Atlanta, and climbing and continuing to climb as the population continues to grow, because we's crowded here. So if y'all are thinking about moving to Atlanta, we's crowded here. There's a lot of other great cities, I'm sure. So yeah, it's a lot of people in Atlanta. And if you have not experienced Atlanta traffic, we are not trying to have that get anything like LA traffic. But, people are going to come. And so we just forewarn people that live here who are still on the fence to purchase a home, might want to act sooner rather than later, because those homes will get snatched up rather quickly by other individuals. And I will say this also, people who are moving to Atlanta from LA, San Francisco, New York, Miami, some of these other, Dallas, Austin, some of these other major cities where the average housing prices might be in the 500,000, 600,000s, or in LA, you might have $800,000 $1 million housing prices in San Francisco. Atlanta is considered still very affordable and cheap. I mean, if you are coming from LA or San Francisco, where all the homes are like 1 point something million, and then you come to a major city like Atlanta, where the traffic is like half of what it is in LA, or less than half of what it is in LA, and the home prices are like 400,000, 500,000, you're like, oh, I could do this. I could sell my home in LA. I can move to Atlanta and buy 2 homes, and, or buy a mansion essentially for $1 million. And so and
a lot of them did in 2020 and 2021. A lot of them did.
They did for sure. And so whereas those of us who knew what Atlanta was back in the day and what it's grown into now, it's it seems expensive, but comparatively, it's still lower than other metropolitan areas.
Mm-hmm. Yeah, I've been hearing this statistic between April of 2023 and April 2024. We added just under 63,000 residents here, which is around 170 people per day, new residents per day.
Wow.
And the last I heard, it was 150 people per day. So I don't know where all these people are going. I don't know where they're living. All I know is that I have a roof over my head, which I'm grateful for, but that's a little ridiculous. I mean, but obviously the assumption is that most of these people are renting, because if it takes a 6-figure income to afford a home this year, so from what you gathered from the article, was it just for Atlanta, or was it, I thought it was Metro Atlanta, like the whole even the, metro Atlanta area,
Yes. So it is
right?
the metro Atlanta area, which for everyone who does not know, because, people listening might not be from Atlanta, Atlanta is a growing city. So you've got Atlanta, we'll say Atlanta proper, which is like downtown Atlanta, homes that actually have Atlanta in the city address. But then you have Gwinnett, you've got in Gwinnett, which is a county. In Gwinnett, you've got Norcross, you've got Lawrenceville, you've got College Park, which is
Loganville.
another city. You've got a lot of cities out Loganville, exactly. So you've got like a lot of cities outside of Atlanta, which are all considered part of the metro Atlanta area. So you might have some people that say, "Oh yeah, I'm from Atlanta," and it's like, "Oh, where do you live?" "Oh, I'm in Marietta." Well, Marietta's exactly. I've had Kennesaw before too. They're, "Oh yeah, Kennesaw, that's way up there," but okay. But then, there's people that live in Noonan who say they're from Atlanta as well, because Atlanta is just constantly growing. And it's like, okay, so there's a lot of cities which are wrapped up in what we call the metropolitan Atlanta area. And that is the area where, I guess, according to some recent studies or articles, they say now you need to have a 6-figure income in order to live in Atlanta. So that's a shocker. And that's not to say you can't find a home without a 6-figure income, because personally, as a mortgage loan officer, I absolutely 100% without a doubt can tell you I have financed people for homes who do not make 6 figures. And actually, a lot of people I have financed for homes who don't make 6 figures. So it is still possible to find those homes. However, it is becoming harder and harder to make that leap into home ownership if you don't have a higher income.
Well, I think in those cases, it's really important when you don't have that 2 income or just a 6-figure income, household, that you're making sure that those debts are under control, because that's the other factor that eats into how much money you have available for a house payment. So, I believe the statistic is 46%, currently 46% of Metro Atlantans' income is going towards housing expense, around $2,960, so just under $3K a month, just for housing expense. And that sounds about right when you add in mortgage insurance, taxes, in addition to, some people pay monthly for a home warranty, or they pay, I'm assuming that also included like the electricity bill, the water bill, the gas bill, your housing actual living expense is 46%. But what's affordable is considered 30% of your, income going towards housing expense. But here in Atlanta, it's like 46% of people's income is going towards housing expense. So
Yes. Yeah, and it is that high. I can say, again, just with my profession, because I'm looking at debt to income ratios, how much people have in their income, what percentage of that is going toward paying debt, what percentage of it goes toward the housing payment, and what percentage of it goes toward, do they have leftover or remaining, what we call residual income at the end of it. And so, yeah, it's whereas they used to say, if you take the Dave Ramsey approach, at 25% of your income needs to, no more than 25% of your income should be going toward purchasing a house. If you follow that model, that he teaches. And I'm like, if we follow that, I would be out of a job because I couldn't finance anybody. All of my clients have a much larger, I think I've had like a small handful of people that actually made so much money to where it was only 25% of their income. But for everybody else out there, it was like they're over 30, 40%. I actually financed someone that was at 48% of their income, like 48.5% of their income that was going to the housing payment, which is something that you can actually only do with like a conventional loan, because FHA won't even let you go that high with just a housing payment. So yeah, they had like 48% of their income that was going toward the housing payment, which is a lot.
Do they have to have like a stellar credit score for that as well?
You do have to have at least,
Usually.
a good, you can't have like a 620 essentially. You know, if you're up in the 700s, it helps out a lot. This particular individual, they actually, if I remember correctly, because this was actually a couple years ago, I think they may have been in the high 600s, 680s, around that range. But yeah, the higher your credit, the better it is, or the easier it is going to be for you to be able to get qualified.
Totally off topic, but still kind of on topic. Do you, as a mortgage lender, keep up with, or do you even look into how many people like eventually default? I mean, I guess that's kind of depressing to think about or talk about, but
So
it's such a happy occasion, and then it's like,
yeah. Not after the first 6 months. And I'll explain. So for mortgage lenders, 6 months is like our safety zone, or we're still holding on to our seats zone until we get past that 6 month part. Because if you default or stop paying that mortgage within the first 6 months, then basically we could end up having to, pay back our commission essentially, because what we're paid on the mortgage side of things, it's like, we get paid a commission, which is, based on a percentage of the loan amount. But part of that gets paid out of, what we're paid, or what gets paid in that first few months of having that loan and everything. So if someone were to originate a loan and then all of a sudden after 1 month or 2 months, it's like they're defaulting, they're not making those payments, well, then there was no money to pay us, if they're not making those first, at least 6 months of payments or everything. And so essentially, if that loan were sold to Fannie Mae or Freddie Mac, they could say, okay, all of that money that needs to get paid back, all the extra stuff that, whatever, if our commission and everything, we could end up losing that and having to pay that back. Whereas the agents don't have to worry about that as much, because nobody's coming back. If they stop paying, no one's coming after your commission. But on the mortgage side of things, within that first 6 months, our commission, can essentially still be on the hook. So yeah, we pay attention to defaults with up to a 6 month period. And then after that, it's like, I'm not going to say default all you want. We want you to make your mortgage payments. We want you to, be responsible and everything. But we definitely don't track it. Yeah.
Yeah. For a realtor, our commission is considered earned once the transaction closes. We have no further obligation, whichever side we're on, whether it's to the buyer or to the seller. Especially no, financial or fiduciary duty. All of that's considered done once the transaction closes, even though sometimes you may have a buyer with buyer's remorse, calling you, asking you, to give an explanation for this or to help them with that, but it is what it is. And so, I didn't know that. That's very interesting to know about the mortgage lending side of things.
Yeah. And
wow.
So when I've spoken with a few agents, a couple agents who said, oh yeah, I think I'm gonna go get my mortgage loan or mortgage originator license, MLO, mortgage loan originator's license. And I'm like, okay. And I'm thinking, how much do you know about the mortgage industry? The commission's not quite as much as what you're making on the real estate side. And you're getting paid a percentage of the loan amount, not a percentage of the purchase price. The loan amount is, 99% of the time always less than the purchase price, because there's a down payment, and our commission isn't based off your down payment. So, that's gonna obviously make it less as well, in addition to the percentage. And then, having your commission kind of just on the hook for that first 6 months. And so, you're calling up with people, hey, just want to make sure you're set up with your payments at the, whoever their loan is through, to make sure, you're good to make that first month's payment, and we get you off to a great start. And, obviously, obviously it's, you know, it's a good thing to do, but it's also because like, hey, we like to keep our check. We don't want to lose that after having done
Yeah.
all this work to get it. But yeah.
Right. Right. Wow.
But yeah, no, it's it is what it is. It's one of those things where the people that are in the mortgage industry, they truly do love it. Most of the people, not all the people, but most of the people that I've talked to, it's like a bug that you get bit by. It's like you genuinely just love just the financing side of things. And that's what it was for me, was just
Yeah.
I loved everything about the numbers, the financing, trying to find ways to help people get qualified, learning how the money moves and having to dig into the guidelines to find those areas that we could anchor our clients to help pull them across the finish line, because it's some things that are just, you know, some stuff is just really tough. But if you're one of those, you know, persistent loan officers that are like, okay, we got to find a way. We got to find a way. You know, a lot of times you'll be more successful than not, trying to find those ways to help clients and everything. So that's the part that I loved about it. But yeah, with one thing I did want to get back to with the increase that people did need for their to be able to own a home in Atlanta. I know it's something that people are having across the country as well, not just in Atlanta, but also in other states as home prices are rising just across the board. I wanted to pull up a chart, if I could, that's going to actually illustrate a little bit of that. On average, home prices over the last 60 plus years, I think it's like 63, 64 years, home prices have appreciated or become more expensive on average about 4.3% year over year. It's between 4.1 and 4.3% year over year. So if you go look at the chart all the way back to 1964 over here, and you just see this, you know, it started out pretty flat through the 60s, early 70s, and you start to see it rise up here, and then it's continuing to rise and continuing to rise. Now I'm gonna pause right here at 2007 and say that all of these shaded areas that you see right here, these are all recessions. These are periods where the country went into, you know, a down period or a recession. So as we get into 2007, you know what, we're at the start of that '08 recession. So we get into 2007, 2008, we're in that recession, which is this big shaded gray area right here, bigger than a lot of these other ones. And so everything dropped. And then we get over here to 2009, where we hit pretty much the bottom, and it starts back climbing again. You see it shoot up, and then we get here, this little small blip on the radar right here, which is 2020. And everything just took off after 2020. You had this little dip right here, and this actually stops at about 2022. But if you were to look at it now, it started trending back up again. And so one of the things that I did want to say about this chart is that when you look at these periods of recessions, notice what the housing prices are doing. They're relatively staying flat or slightly increasing throughout these recessions. Real estate has been a very stable and a very secure investment. It's been an investment that has generated a lot of wealth for a lot of people. And as you can see, it's been very resistant to, you know, those drops that you see in the stock market, because if you were to look at the stock market through all these recessionary periods, you would see huge drop-offs. When stocks start, you know, falling, we go into a recession, everyone's selling stocks and everything like that. But real estate has held its value or increased in value throughout recessions. The one outlier being right here, this '08 recession, which was caused by the real estate industry, which a lot of bad mortgages were written. So you could really say the mortgage industry, which a lot of bad mortgages were written. And that's what caused that drop here in '08. A lot of people like to point to '08 saying, oh, we're going to have a whole nother housing drop. And but if you go back 60 plus years, you can't find another '08. So that '08 was the only '08 that you can point to in the last, you know, longer than what most people have been alive right now. And so I like to say that, you know, a lot of people, when they are looking at what's going to happen with home prices, and they're looking at, home prices possibly coming down to a range where they can afford home prices, you actually are better off trying to find ways that you can increase your income. Like we were talking about here with that 6-figure income, it seems like a lot, but you have to actually dig in and find a way to get your income higher. Maybe you have to make, if you're working in sales, more sales calls. Maybe if you're working, an hourly job, I hate to say put in more hours because, it's just, it might not even be as big of a payoff. Maybe the better option is going to be for you to find a job that's going to pay you better for the work that you're putting in within that same number of hours. Maybe that's the thing that you need to start looking for or pursuing. But home prices, banking on home prices to come back down to match your income is a losing bet, if you ask me, because as you can see with what home prices are doing, they're just constantly going up and up and up. And I'll stop sharing the screen here for a minute, but that's just to paint the picture that it's not going to be to your benefit to continue to put off purchasing a home, because home prices are going to continue to get more expensive. It might be 6 figures that you need now. Wait another 15 years, you're going to need to be making, 150,000, 170,000, because prices are just going to continue to go up.
What metro area you live in now. If Nebraska or Idaho somehow, comes onto the map for, whatever there's a lot of industry here. There's a lot of, movie, film, music, and I think that's, a lot of the reason why the real estate has popped off like it has, just like in LA, the traffic, so a lot of people move there because they want to make it big. And they know that it's going to attract movie stars and producers, people with that kind of money. And so Georgia, Atlanta, we have several music and movie studios. So it's just attracting that kind of demographic that can pay more. And it essentially pushes us out. But, back to your chart, I think one reason why real estate is not as cyclical and doesn't have as many like dips and highs and lows as the stock market is because obviously, the stock market, your stocks are going to be a lot more liquid than real estate. You can sell off a stock in 24 hours if you want to. But with a home, we're looking at 2 weeks minimum. I think one of my loan officer friends a while ago, or it might have been you, told me that the minimum amount of time required by law. So the quickest way to sell a home is a cash sale. If you have a cash buyer, it's by far the quickest. But I think the minimum amount of time, if you're doing financing, that you can take to close a loan, is it 8 days? Is it 8 calendar days? Or something like that? Or am I wrong? 10, okay.
And usually your closings are going to happen closer to, at the earliest, I would say generally like 2 weeks.
Okay.
Or a couple weeks. Yeah. And that's like really quick turnaround to get it done in 2 weeks. But because 30 days is what you commonly see. But yeah, it's 10 days usually. And that's because, you've got the federal requirements that I believe it's 10 days. I'll need to go back and check because it's definitely not a number I'm usually shooting for. That's how quick of a turnaround it is. If you're buying a home and you're trying to get that thing turned around in 10 days, something life-changing is happening that's requiring that need for that to happen so quickly. But no, it's I believe it's about 10 days, but yeah, it's mainly because of the requirements that are put in place by the federal government to make sure that the home buyers have time to review all of the documentation that they're going to get from their mortgage lender to make sure that they understand it. They can ask questions if they have questions. They've got time to shop around and compare with other lenders if they want to. So that's why one reason a lot of that stuff is put in place is like, hey, you get your closing disclosure. It's not that we can give it to you at the closing table, or give it to you the night before, and then we're closing the next morning. And it's like, you didn't really have time to review everything and ask questions and make changes if need be. So they have that, those rules in place for that reason. Oh, but one thing I did want to get into as well, because I didn't want to leave everybody with just doom and gloom of, you got to make more money, home prices are going to continue to get more expensive, but also wanted to talk a little bit about the cost of home ownership today and some tips on what people can do to overcome that income barrier as well. So we already talked about one tip being make more money. I don't know if that's a tip, but that is
easier said than done, brother. Easier said than done.
It is. Just make
most
more
people
money.
want to do is work even harder or get another job and spend more time, like an additional job, and spend even more time working.
Yeah.
Most people already feel overworked. They feel like they spend too much of their time, too much of their life, too much of their day, either in traffic or at work, doing activities that's going to take them to work or take them home from work, like some sort of work related activity. So I think it would be more advantageous to get something where you are making more money, but that takes education or just knowing someone or experience, oftentimes specialized experience that the majority of the population, I would say half and half. It's a lot of people that don't have that education. So, what do they do?
Some people who did get the education now are under a pile of student loans that are now preventing them from being able to purchase a home because they've got all these student loans, and the jobs that they were hoping to be able to find after they got out of school with the education, they have not been able to find those jobs. So yeah, it's a lot of that, but I will give I'm gonna give some more helpful stuff other than just make more money. I'll say that another thing that, well, first I'll say this: think outside the box and get comfortable with being in a situation that might be a little bit uncomfortable, even if mentally uncomfortable for you to try and just fathom it. And I say that before I get into what this first suggestion is, which is consider purchasing a multifamily property with someone that you trust. It could be a friend, it could be a family member, but it can be easier for you to actually qualify to purchase a multifamily property when you're going into it with someone else, or even if you're not going into it with someone else. But if it's the right multifamily property that rents for enough to cover the mortgage, meaning if you're renting the other units for enough to cover the mortgage, you essentially only need to qualify for the unit you're living in, or, a portion of that. You don't have to qualify for the whole multifamily. For example, let's say that you find a duplex, and that duplex is $400,000. You might not qualify for $400,000, but if one unit out of that duplex, let's say if that one unit rents for $1,750 or $1,800, then that $1,800 that you're getting in rent from that one unit can help you to qualify for that $400,000 payment. So you're not having to pay for the entire, or you're not having to qualify for the entire $400,000. You just have to take your income, and when you match it up with what the current multifamily property is renting for, then the total sum of that needs to be able to cover that $400,000 purchase price. And that's something that can help you be able to purchase a home. And I started off by saying you can go in it with a friend. You don't have to, but if you do, have a friend or family member that you trust and say, hey, you're looking for a place to live. I'm looking for a place to live. Let's go find a multifamily property. You'll have your own unit. You got your own space. I've got my own unit. I've got my own space. And we're both responsible for covering, the mortgage payments on this thing. And that way, that's one way that you can also, make it happen and be able to put you all both in a home, especially when neither of you are able to qualify by yourselves, but you may be able to qualify together.
So when you're using that other unit as essentially almost, I guess, maybe like stated or potential income, when it comes to the lender side, are they looking for it to already be occupied before you purchase it and making money at the current time of purchase? Or would they just accept the fact that, okay, $1,800 is the market rent, we're pretty sure we're going to get a tenant, like, is that good enough to actually be able for a single person to go ahead and qualify.
Yes.
All right now. All right.
So on to the next now. So the answer I would say is yes. It's both of those, right? So like if you find a duplex, a quadruplex, triplex that the units are already rented, then the underwriters can take that into consideration and they can say, hey, this is what the units are already renting for, current lease agreements that are in place. Maybe you have one lease that's going to be continuing for the 6 months after you purchase, another one for a year after you purchase, maybe the next one's expiring a month after you purchase, but they see what that place is already renting for, and that helps provide justification for what the underwriters will allow to be calculated for the rental income. But even if you were to get a multifamily property that's vacant and no one's renting it out right now, a mortgage lender can still count the rental amount that will be received from those properties based off of a fair market rental assessment of that property. And so what will happen is when you have your appraisal done, in addition to that 1004 is what we call the, your regular appraisal that you get. There's also what's called a 1007, which is a fair market rental assessment that will be done on the property. And that fair market rental assessment will be determined by that appraiser as to how much, based on the market, that unit would rent for. So that appraiser will look at comparable rental properties for multifamily properties in the area, and they'll make the determination, this unit will rent for $1,600, or the fair market rental value for this unit will be $1,600 or $2,000 a month, or whatever they determine. And if it's a vacant unit, then that's the number that we or the underwriters will go off of to determine how much we can count to help supplement, what you should be getting in rental income for that multifamily property.
Okay, so it's the appraiser who determines the fair market value on the rent, not the agent or whoever. Okay,
exactly.
Very nice. Learning something. Keep on going, brother.
Yes, no, absolutely. So another tip that I have for people who are trying to figure out how they can make it in this market, this one's going to require a little bit more discipline.
Oh, well, count me out, honey. I'm just playing.
Folks have to stop spending so much money that this is not providing them a return on where they're wanting to go in life. I see so many individuals that they're spending money on cars. They're spending money on trips. They're spending money on food.
Eating out, yes. Cigarettes. Yes. Cigarettes is a big one.
Oh, yes.
Cigarettes, Lord have mercy. $300 a pack a day.
When I was in the military, I used to work with an admin person. I'll put it like that. Who every morning he drank Starbucks, and it was like an $8 something. I don't know what he ordered, but it was like a $7-8 something from Starbucks every morning. And I'm like, okay, so if you do the math for that, you're spending $8 a day.
I already did it. Hold on, wait, let me see.
Oh, what's that? $2,900 a year that you're giving Starbucks.
Lord have mercy.
And it's like, the money that you're spending, and that's just on your coffee, but how much time do you spend going out to eat at restaurants versus cooking a meal at home, which could save you a good bit more money? Or, everybody's wants to live the lifestyle they see everyone else flaunting around on Instagram or whatever, social media channel. But it's like, you could actually.
And they renting.
Say it again.
Maybe they renting.
Oh, yeah, absolutely. So all of that to say, let's live beneath your means, not even at your means. Live beneath your means so that you can start saving up money to be able to make that home purchase. Because a lot of the times the difference between you getting into a home and you not getting into a home might be that maxed out credit card from that trip that you took, or that maxed out credit card that comes from you shopping for clothes every month, or, eating out at restaurants every week.
3 times a week.
Exactly. So cut back on how much you're actually spending. Take inventory on where you're putting that money, because that's something that can be a difference maker.
Mm-hmm.
And then lastly, let me pull this back up. If you're trying to make it into the housing market this year, next year, in the foreseeable future, but your income is not in six figures, look into the programs that are out there that can help assist you with becoming a homeowner. And I'm not just talking about down payment assistance, because down payment assistance is not going to help you qualify for the mortgage. Down payment assistance will help you take care of some of the upfront cost of that mortgage, down payment and closing costs, but it's not going to help you qualify for the loan. There are some programs out there that will help get you lower mortgage payments through having a lower interest rate. I'll throw Georgia Dream out there as one. For example, if you're a veteran who's purchasing under the Georgia Dream program, I actually financed someone who had under a 5% interest rate. It was like a 4.875% interest rate earlier this year, which, how much does that help you qualify for a home when your payment can be, $200 less than what it would be if you did not have access to that program. So that $200 can make a huge difference. And actually that $200 could make about a $35,000 difference on your purchase price. So it can make a big difference in terms of you being able to qualify for something, not being able to qualify for something. And so knowing those programs that can help you reduce your monthly payment via getting a lower interest rate, but also there are some programs that can help reduce your mortgage insurance. There are some conventional loan programs that actually, if you're a first-time home buyer, and obviously you've got great enough credit to qualify, you could actually have a lower mortgage insurance payment. So you've got your payment when you go to purchase a home is formed of principal, interest, taxes, and insurance. Principal and interest based on the interest rate and the principal amount that you borrow. Taxes, property taxes that you have to pay, city taxes if you live in the city limits, county taxes depending upon the county that you live in. But then you got two types of insurance. You've got homeowner's insurance, which protects your home, and then you've got mortgage insurance, which protects the lender in case you default on that mortgage payment. So when it comes to mortgage insurance tends to be high if you take a conventional loan and your credit score is not great. However, there are some programs for first-time homebuyers that are out there which could help reduce how much you're paying in that mortgage insurance. And again, even if you're only reducing it by, $100 or even $80, that $80 could get you another $10,000 worth of purchasing power. So just $70 or $80 a month that you're reducing your mortgage payment could help you qualify for that home that you really need, that's going to work better for you and your family, by having to settle for something or not being able to qualify at all, because who knows, that $10,000 could be the difference between you getting a home and not getting a home, or $20,000 or $30,000 could be the difference between you getting a home and not getting a home, because maybe you could find something for $210, but you can't find anything for $180. So those are some of the things that you definitely want to look into, is making cutbacks where you can make cutbacks on, but making sure that you also are looking into those programs that are available, which can really help reduce your monthly mortgage payment, because the lower you can get that monthly payment, that increases the amount that you could actually qualify for in a home as well, particularly in an environment where housing prices are just continuing to rise.
Yeah, I have some agent friends who just refuse to take their clients through some of these first-time homebuyer programs because, they delay closing, or they take longer to close, or they, interfere, or they just have so many, the conditions, they have to meet all these conditions, or they can over condition the clients. But to me, that's on the agent side. My thing is, yes, you want to get to the closing table, but you really want to be there to help your buyer, because in the end, if they default in those first 6 months, and you kind of have a hand in that, if you're not really doing all you can to make sure that this mortgage is as affordable as possible for your client, because especially when they're first time home buyers, and especially if you as an agent have been or are a homeowner yourself, we just have to remember to have that compassion for people, and just remembering to do all that we can, even if it means there was a agent that called me earlier this week, I guess it was Monday, and she was saying, we're offering a 4.99% interest rate. I was like, oh, that's really good. Of course, I think you would have had to go through the builder's preferred lender. It was like new construction,
Mhm.
but whatever you can do. And then there's always lenders emailing me. They have all these different programs coming out all the time. My favorite are the first time homebuyer programs, or the conventional loans where you don't have any private mortgage insurance, not just reduced private mortgage insurance, but, they're out there. And I feel like as agents, it is definitely our job to make sure that we're making contact with all different types of lenders, all different types of programs, because what may be good for the goose may not be good for the gander, or vice versa. But
Mhm.
every program is not, there's no one size fits all program purchase to help you purchase a home. But yeah, I completely agree with you. I completely agree with you. Those are some really great tips. Really
Oh,
great
thank
tips.
you. Yep, and you mentioned one that I didn't mention, which was in terms of finding those programs that could work for you. New construction is one where sometimes you do have those builders that are offering those lower interest rates, and if that is something that's if it's a home that's going to work for you, and you're able to go through the builder's lender and get that 4.99%, or whatever that lower interest rate is, that's something that you'll want to look into as well, because that could be the difference maker for you if you're, buying that new construction home, by getting a home that maybe your interest rate will be a little bit higher if you didn't take, that deal. So there are some those deals out there as well. I will say, because I can't just say go for the lower interest rate without also telling people to make sure you read your loan estimate, know the costs that are in there, know how much you are actually being charged for those interest rates. There is a loan cost section in your loan estimate. And in that loan cost section, it lists how much you're paying in origination fees, how much you're paying in discount points. A lot of times you may be quoted a low interest rate, but you need to check your loan estimate to see if they're charging you discount points, because if they are, you could be paying for that reduction in interest rate. And I've seen that before, where home buyers have been quoted a really low interest rate, and then their closing costs were super high because they were not told. And when you're a first time home buyer, you might not know what a discount point is. So you're not knowing what to look for in your loan estimate, but they were not told that, oh, you're actually paying $20,000 and it was actually a little bit more than 20,000 for this particular client, but they were not told they were going to be paying $20,000 to get this really low interest rate that they were quoted. And so you want to make sure you read the loan estimate so that you fully know and understand. Ask questions, but you want to make sure that you fully know and understand how much is it going to cost me to get this interest rate. Interest rates have a price associated with it, and make sure you get that price in dollars, not discount points. Make whatever loan officer you're talking with convert that into dollars for you, so that you can accurately compare apples to apples and know, okay, should I pay $15,000 to get that 5% interest rate, or should I pay nothing and get a 6% interest rate?
That's good advice. You gonna make some of these loan officers out here hate you, though.
Oh yes,
He's giving away all the secrets.
I
But
will
no, that's
promote.
good.
Yeah, and because at the end of the day, I'm just, when you see so many people get screwed out of their money.
Burn. Yeah.
Exactly, because they're like, oh, they did some stuff that they were not aware of. They made some bad decisions. Yeah, it's I just really want to help people not step into those same problems that I've seen so many other people step into.
Yes,
But
yes.
yeah.
It's a predatory world out here. You got to be careful, you know, buying and selling property. I saw a 7.17% interest rate on one of my listings, a buyer for one of my listings. And that's the highest that I think I've seen yet.
Mm,
So it's I, for me, business hasn't necessarily slowed. I have 2 properties under contract and 3 properties that are pending listings coming on the market. So the for me the I never say that it's a bad market, and I told my friend the other week, even if it was slow for me, you would never hear me say that. I wouldn't ever give, room for any negativity, but um I've I've had more listings than
hmm
buyers. I have personally tried to get 3 buyers since the top of the year, 3 buyers approved, and none of them have been able to get approved. But to me, what that tells me is that people are in need of cash. They're in need of
hmm
money. So, I've had all these listings because people are selling. And then these listings are staying on the market longer. And so the buyers are more hesitant, or, it costs more to borrow money right now. So, one of the best ways that I can think of, and this is what I tell people, my buyers all the time, one way, the best way to make a loan more affordable is to make sure that you can get your credit score to the highest possible place before you get ready to apply for a home, because people with lower credit scores pay more for everything. You pay higher deposits when you're renting, you pay higher, payments when you're purchasing. So, you owe it to yourself. Those $200 and $300, direct TV things that's dinging your credit, or you didn't turn in your cable box, or you have $1,000 medical bill, or a $500 credit card that you haven't paid off. Those amounts are too small to be being counted out of home ownership, or to keep yourself from getting that as low of an interest rate as possible. It's
hmm
just not worth it. So take care of what you can, get your credit score to the highest place possible before you purchase. And, that's also another thing that you can do to make home ownership more attainable. So,
Yeah. Well, no, good stuff. I think
mhm.
that's a good spot to wrap it up. So hopefully this has been beneficial for some people out there to get them to
Yes.
be able to at least cross over that hurdle, that bridge into home ownership and everything like that, because it's not getting cheaper. So you have to get
Mhm.
better. It's I
Yes.
see it like a race. The competition is not slowing down. You're going to have to get faster. And
Yes.
so same thing
I
in the
love
housing
that.
market. Yeah. Same thing in the housing
Mhm.
market. You're going to have to find the ways to make cutbacks where you can, but get better in other areas, make more income, get very creative, and make it happen.
Mm-hmm. Mm-hmm. Yes, sir. And I don't
And
think that any of this is something that people don't know. They've heard it before, but they just need to hear it again. So
well,
it's true.
until next
Mhm.
week, yeah, make sure you tune in. Tuesdays, Home Finance Hacks. I'll be live again on Tuesday, 7 p.m. Eastern Time, for Home Finance Hacks. And then Friday, we'll be dropping another episode of Greatest Asset Community Podcast. So make sure you tune in on Fridays as well. And until next time, take care, be blessed, and we'll see you next week.